You're not watching a market breakdown right now. You're watching a pressure gauge. And almost no one tracking financial news this week understands what it's actually measuring. Welcome back to SilverDispatch. I'm OG Peter. Today we're going deep on silver and gold. We're examining a shift in global energy infrastructure that hasn't had a parallel in 6 decades. We're walking through what's happening inside the Federal Reserve right now, and why the man currently running its press conferences may not be the one effectively directing policy a month from now. We're looking at 4 companies with a combined valuation north of $11 trillion reporting earnings tonight, and we're mapping exactly where silver sits inside all of it. Because where silver sits right now is not where it will be when this week closes out. Let's get oriented with the numbers. As of this morning, silver is trading at $72.54. Gold is at $4,162.90, down about $30 on the session. Now, before we go any further, those prices matter less than the conditions underneath them. The movement you're seeing today isn't being driven by shifts in industrial supply or overnight changes in physical demand. The physical market for silver is not the mechanism setting this price right now. Headlines are, one specific headline is, and the moment that headline meets the friction of documented reality, as it always does, what you see on that screen will look substantially different. I'll name the headline precisely in a moment. But first you need the structural foundation, because without it, the price level on your screen looks like a data point. With it, it looks like a historic threshold. Here's something that deserves to be at the top of every silver conversation this week, and is getting almost no airtime in mainstream financial coverage. Delivery pressure on physical silver at the COMEX has not eased. Not meaningfully. Not at all. For anyone newer to this channel, delivery pressure is the widening gap between paper commitments in the futures markets and the certified physical inventory actually available to satisfy those commitments. When that gap expands, when open interest for delivery outpaces what vaults can back with real metal, the paper price begins separating from the physical reality under it. That separation is a structural signal, not a technical blip. This pressure has been building for weeks. As of this morning, no significant drawdown in certified inventory has corrected it. No large physical movement has closed the gap. The pressure is intact, and structural pressure in a physical commodity market doesn't dissolve because a story changes on a Tuesday afternoon. It resolves when metal actually moves. Right now, metal is not moving in the direction that closes this gap. That fact is the lens through which everything else today needs to be read. Let me tell you directly what is driving today's silver price action, because you deserve the unfiltered version. The current narrative is built around a claim, made without a date, without a named source, without any supporting documentation, that Iran has communicated a state of collapse through direct contact with Washington. Trading algorithms responded immediately. Of course they did. Algorithms are built to register signals, not interrogate sourcing. However, here's what the oil market is actually pricing. Brent crude is sitting above 98. Not 75s, not 82. 98s. On the same morning, this collapse narrative is circulating. Because commodity markets run a physical supply calculation in real time, and that calculation reflects something the narrative market is not adequately discounting. The Strait of Hormuz has been functionally restricted to normal tanker transit since April 13th. That is over 2.5 weeks of disrupted flow through one of the most critical maritime choke points on this planet. This is where it gets interesting and consequential. In 48 hours on May 1st, 2026, the United Arab Emirates formally exits OPEC after 58 years of membership. Let that sit for a moment. The 3rd largest oil producer on Earth, walking out of the cartel that has coordinated global energy pricing since the early 1960s. The official explanation references production flexibility and a capacity expansion target. The structural explanation reads differently. The UAE is under direct Iranian military pressure. Drone and rocket operations have been targeting UAE infrastructure with sustained regularity. 95% of Abu Dhabi's state revenues depend on a waterway that an active adversary is using as a military instrument. Under those conditions, cartel loyalty stops being a strategic asset and becomes a liability. So they're leaving. Serious energy analysts are describing the UAE's departure as the 2nd largest structural shock to global energy architecture in 60 years. The first on that list is the 1974 petrodollar agreement, the arrangement that made the US dollar the mandatory settlement currency for global oil transactions, and built the foundational architecture of modern dollar hegemony. The UAE exit doesn't carry that magnitude in isolation, but it signals something that does: the fracturing of the coordinated pricing framework that has governed global energy for 6 decades. What Washington has achieved through the pressure of this conflict is something it has been pursuing for a long time: the fragmentation of OPEC's collective leverage. What remains is a Riyadh-anchored remnant with diminished unity and significantly reduced pricing power. This matters for silver because dollar-denominated energy architecture has been the backbone of global dollar dominance since 1974. When that architecture shows structural cracks, capital allocated within dollar-based systems begins seeking alternatives. Physical precious metals are among the primary destinations for that reallocation. We are watching that process begin. Today is Federal Reserve Day. Tonight at 8 Eastern, the Fed announces its rate decision. The CME probability model prices a 100% probability of a hold at 3.75%. The number itself is not the story. The story is the sequence of events that has unfolded alongside this press conference, and what it signals about the independence of American monetary policy going forward. The Department of Justice, operating under a direct presidential appointee, closed a criminal investigation into Fed Chair Jerome Powell earlier this week. The investigation concerned renovation cost overruns at the Federal Reserve's Washington headquarters. It was closed without charges. On the same day, the Senate Banking Committee is voting on the nomination of Kevin Warsh, a figure with a documented pattern of aligning publicly with whatever the prevailing Republican leadership required on interest rates, to effectively succeed Powell in directing monetary policy. The president has stated explicitly that he intends to co-design interest rate decisions. The investigation into the sitting chair was closed. The replacement is being confirmed today. The press conference is tonight. This is not a procedural rotation. This is the most consequential shift in American monetary credibility in at least a generation. The market is reading it as administrative process. It is not administrative process. When monetary policy becomes structurally subordinate to political priority, the rate of currency debasement does not moderate. It accelerates. And when debasement accelerates, the purchasing power case for holding physical silver doesn't soften. It strengthens. Now layer in the macro backdrop. The Atlanta Federal Reserve's GDP Now model is currently tracking first quarter U.S. growth at 1.2% annualized. Wall Street consensus sits between 2 and 2.5%. That is not a rounding difference. If tomorrow's advanced Q1 GDP release comes in anywhere near the Atlanta Fed's model, the United States is not in a growth environment. It is in a stagnation environment with inflation above target, which is the textbook definition of stagflation. In Germany, business confidence, as measured by the IFO index, has fallen to 84.4, the lowest reading since the first COVID lockdown in May 2020. Official growth forecasts have been cut in half. And here's the figure that tells you what $98 oil actually does at the operational level. The German Bundeswehr, working from a 100 billion euro defense fund, failed to complete a routine procurement order for diesel tank containers because energy inflation pushed the prices past what the authorization system could approve. That is not an anecdote. That is a precise measurement of what energy-driven inflation looks like when it reaches execution. Silver is not isolated from these dynamics. It is the exact asset that these dynamics activate. Tonight, after U.S. markets close, 4 of the 5 most valuable companies on Earth report quarterly earnings simultaneously. Microsoft, Amazon, Alphabet, and Meta. A combined market capitalization of approximately $11 trillion, resolved in a single hour. This connects directly to silver in a way that isn't being discussed. Microsoft's key figure is Azure cloud growth in constant currencies. Management guided 37 to 38% growth earlier this year. However, the AI capital expenditure narrative has already produced 2 structural fractures this week. Semiconductor names down 3 to 4% following reported revenue shortfalls, and the formal cancellation of OpenAI's Oracle data center partnership in Albany, Texas, citing failed financing. That is the second major crack in the AI infrastructure spending story in 7 days, arriving directly from the company that launched the entire AI build-out narrative. If Azure disappoints tonight, if Amazon's cloud segment becomes a third crack in the same story, if Alphabet's core revenue engine continues its court-mandated dismantling while AI investment climbs, $11 trillion of equity value does not evaporate. It moves. And in an environment where the Federal Reserve's independence is being structurally altered, the Strait of Hormuz is contested, OPEC is fracturing, and physical silver delivery pressure remains unresolved. That capital does not park in 3.75% treasuries. It looks for stores of value. Here's what the numbers beneath the surface are also telling us. China imported approximately 836 metric tons of silver in March alone. That is nearly triple the 10-year average for the month. Chinese retail investors are purchasing small-format physical silver bars at an accelerating pace. Chinese photovoltaic manufacturers stockpiled aggressively ahead of export policy changes. And Chinese silver prices have been trading at meaningful premiums to international benchmarks, pulling physical metal eastward through Hong Kong arbitrage flows. Western retail demand is relatively subdued. Physical product is available near spot. That absence, the Western retail buyer not yet arriving at this market with conviction, is a feature of this moment, not a bug. It means the structural repricing hasn't begun in this hemisphere yet. Silver is also the most electrically conductive metal on Earth, with no commercially viable substitute in photovoltaic applications. Net silver consumption in the solar sector is expanding, not contracting. And in a world where contested sea lanes have made energy security the primary concern of every major economy simultaneously, the urgency around solar capacity expansion is not diminishing. It is accelerating. 3 independent demand vectors: photovoltaic industrial demand, Eastern monetary accumulation, and the purchasing power case strengthened by today's Federal Reserve transition, are all currently active and pointing in the same direction. The paper price at $72.54 has not priced any of this. That gap between structural reality and current price is the position worth understanding clearly before tonight's session begins. I'm OG Peter. This is Silver Dispatch. I'll see you in the next one.